Imagine waking up tomorrow morning, checking your phone, and seeing the stock market swing hundreds of points before you've even finished your first cup of coffee. Gold jumps, or crashes. Treasury yields move in seconds. Financial news channels suddenly change their headlines. Analysts rush to explain what just happened, and millions of Americans are left asking the same question. What does this mean for my money? The truth is, those dramatic moves may not begin with a war, a presidential speech, or a surprise announcement from the Federal Reserve. They could begin with just one number released in a matter of seconds. A number that Wall Street has been counting down to for weeks. And in the next few hours, that number could change the direction of the entire market. Now, if you've worked for decades, built a retirement account, invested in gold or silver, or simply want to protect the value of your savings, this isn't just another economic report. It matters because every major financial decision, from interest rates to mortgage costs, bond yields, stock valuations, and even precious metals, starts with understanding what this one report tells us about the health of the American economy. Today, we're going to walk through that chain step by step in plain English. No complicated financial jargon. No sensational predictions. Just the real economic mechanism that professional investors, central banks, and institutional traders are watching before the opening bell. Because here's something most headlines never explain. Markets don't move simply because numbers are good or bad. They move because those numbers change expectations. Expectations about inflation. Expectations about interest rates. Expectations about the Federal Reserve's next move. And ultimately, expectations about where your money may go next. History has shown us just how powerful a single economic report can be. In 2008, investors watched employment collapse as the financial crisis unfolded, forcing the Federal Reserve into emergency action that reshaped markets for years. In 2020, one devastating jobs report confirmed that the U.S. economy had entered a historic shutdown, triggering unprecedented monetary stimulus and sending markets into one of the fastest recoveries ever recorded. Those moments weren't important because of one headline. They mattered because they changed the direction of policy. And when policy changes, markets change. That's why, over the next few minutes, we're not simply going to look at today's number. We're going to uncover the entire chain reaction that begins the moment it's released, and why millions of investors across America are watching the clock right now. Most importantly, we'll keep coming back to one question throughout this video. What does this actually mean for your money? Because that's the only question that really matters. By the time we're finished, you'll understand why professional investors often react before the headlines are even written, why gold and silver sometimes move in ways that seem completely backwards, and why one economic report can influence everything from your retirement portfolio to your purchasing power. So before the opening bell rings and before the markets make their move, let's begin with the one number that could change everything. So, what is this one number that has Wall Street holding its breath? It's the U.S. non-farm payrolls report, better known as the monthly jobs report. At first glance, it doesn't sound exciting. It's simply a government report showing how many jobs the American economy created over the past month. But don't let its simple name fool you. This single report often becomes the first domino in a chain reaction that reaches every corner of the financial world. Here's the chain, and once you understand it, you'll start seeing the market through a completely different lens. Jobs. Federal Reserve. Interest rates. Markets. Your money. Let's begin with jobs. When businesses are hiring aggressively and unemployment remains low, it usually tells us that the economy is still growing. More people are earning paychecks. More families are spending money. Companies continue expanding. That sounds like good news, and for the economy, it often is. But there's another side to the story. When millions of Americans have jobs and wages begin rising quickly, consumers generally spend more. Restaurants fill up. Airlines sell more tickets. Retail stores see stronger sales. Demand increases across the economy. Now imagine thousands of businesses trying to meet that growing demand at the same time. Prices often begin to rise. This is where inflation quietly enters the picture. Inflation isn't just about gasoline or groceries becoming more expensive. It's what happens when demand grows faster than supply. Businesses respond by charging higher prices, and workers often ask for higher wages to keep up with the rising cost of living. That's exactly what the Federal Reserve watches. The Fed has one of the most difficult jobs in America, keeping inflation under control while supporting economic growth. If inflation stays too high for too long, the purchasing power of every dollar begins to shrink. And that's where interest rates come in. When the labor market stays exceptionally strong, the Federal Reserve becomes more cautious about cutting interest rates. Sometimes it even considers raising them further to cool the economy. Think of interest rates as the thermostat inside America's financial system. If the economy starts overheating, the Fed turns the thermostat down by keeping borrowing costs high. Higher mortgage rates, more expensive business loans, and tighter credit all help slow spending. The goal isn't to stop growth, it's to keep inflation from getting out of control. Now here's the question that matters most. What does this mean for your money? It means today's jobs report isn't just about employment. It's about whether the Federal Reserve feels comfortable lowering rates, or whether higher rates remain with us for longer. And that decision affects almost everything. Stock valuations, Treasury yields, mortgage rates, the US dollar, gold, silver, even the value of many retirement portfolios. This is why professional investors don't simply read the headline number. They immediately begin asking a different question. Will this report change what the Federal Reserve does next? Because that's the real story. The jobs report is only the first domino. Everything that follows depends on how that first piece falls. Now that we understand the economic chain, jobs lead to the Federal Reserve, the Federal Reserve influences interest rates, and interest rates affect almost every major asset class, it's time to step back and ask a much bigger question. Has this happened before? The answer is yes. Not in exactly the same way. Every economic cycle has its own causes and its own surprises. But if you study history carefully, you'll notice that financial markets often follow familiar patterns. The names change. The headlines change. The technology changes. But human behavior, and the way money reacts to uncertainty, has a remarkable way of repeating itself. Let's go back to 2008. When the global financial crisis began, investors weren't thinking about gold. They weren't thinking about inflation. They were thinking about survival. Banks were failing. Credit markets were freezing. The stock market was collapsing. And in one of the biggest misconceptions in financial history, gold actually fell during the early stages of the crisis. That seems impossible, doesn't it? If gold is supposed to be a safe haven, why would investors sell it during one of the most dangerous financial moments in modern history? The answer is surprisingly simple. When fear reaches extreme levels, investors don't always sell what they want to sell. They sell what they can sell. Gold is one of the most liquid assets in the world. During the panic of 2008, many institutions sold gold simply to raise cash and cover losses elsewhere. It wasn't because gold had suddenly become a bad investment. It was because cash became king. But here's the part many people forget. Once the Federal Reserve responded by aggressively cutting interest rates and injecting liquidity into the financial system, everything changed. The pressure on gold disappeared. Over the following years, gold climbed to new record highs as investors began worrying less about immediate survival and more about the long-term consequences of massive money creation and rising government debt. Now fast forward to 2020. Once again, the world faced an unexpected crisis. Businesses closed. Millions of Americans lost their jobs almost overnight. Financial markets experienced one of the fastest crashes in history. And once again, something surprising happened. Gold initially dropped, not because investors suddenly lost faith in it, but because they were scrambling for liquidity. Then history repeated itself. The Federal Reserve cut interest rates to near zero. Massive stimulus programs followed. Governments around the world injected trillions of dollars into their economies. Within months, gold recovered and eventually reached new all-time highs. So, what do both 2008 and 2020 teach us? They remind us that short-term price movements are often driven by immediate fear and liquidity needs, while long-term trends are driven by monetary policy and economic fundamentals. What does this mean for your money? It means today's market reaction, whether gold rises, falls, or moves sideways after the jobs report, doesn't automatically define the long-term direction of your investments. One economic report may change expectations for the next few weeks. But the bigger forces, interest rates, inflation, government debt, and Federal Reserve policy, are the trends that shape markets over months and years. One of the biggest mistakes investors make is assuming that every major headline changes everything. It doesn't. In fact, one of the most important lessons in financial history is learning the difference between a catalyst and a trend. A catalyst moves prices quickly. A trend changes wealth over years. And understanding that difference could save you from making one of the most expensive mistakes investors repeatedly make. Let's start with tomorrow's jobs report. Within seconds of the number being released, Wall Street's computers will begin reacting. Treasury yields may jump or fall. The US dollar could strengthen or weaken. Gold, silver, stocks, and even cryptocurrencies may all move before television commentators have finished reading the headline. That is how modern markets work. Algorithms don't wait for explanations. They trade first. Humans explain later. If payroll growth comes in much stronger than expected, investors may conclude the economy is still running hotter than the Federal Reserve wants. That would likely push expectations for higher interest rates, or at least delay future rate cuts. Higher expected rates generally support Treasury yields. Higher Treasury yields often strengthen the US dollar. And a stronger dollar usually creates short-term pressure for gold and silver because they become more expensive for international buyers. But notice something important. None of that changes the amount of gold sitting inside central bank vaults. None of it suddenly creates millions of ounces of new silver. None of it changes global debt. It simply changes expectations. Markets constantly reprice expectations. That's why prices can move dramatically even when nothing physical has actually changed. Now imagine the opposite scenario. Suppose payroll growth disappoints. Suddenly investors begin expecting the Federal Reserve to become more flexible. Treasury yields could decline. The dollar might weaken. Gold and silver could rally sharply. Again, notice what changed, not reality. Expectations. This is why experienced investors often remind themselves that markets are voting machines in the short run but weighing machines over longer periods. Daily headlines influence votes. Fundamentals determine weight. And this brings us back to the question we've been asking throughout today's discussion. What does this mean for your money? It means you shouldn't confuse tomorrow's reaction with tomorrow's destination. History is filled with examples where markets initially moved in one direction only to reverse once investors had time to process the bigger picture. After major Federal Reserve announcements, after inflation reports, after banking crises, after geopolitical shocks, initial reactions often tell only part of the story. Think back to March 2020. Markets collapsed at incredible speed. Fear dominated every headline. Yet within months, entirely different forces began driving prices. The immediate catalyst faded. The larger trend took over. The same principle applies today. Whether tomorrow's number surprises positively or negatively, it represents one chapter, not the entire book. Professional investors know this. That's why they separate tactical decisions from strategic decisions. One deals with weeks. The other deals with years. And confusing the two has ruined countless portfolios. So before reacting emotionally to whatever headline appears tomorrow morning, ask yourself one simple question. Is this changing today's expectations, or is it changing the long-term foundation? That single question often leads to much better decisions than chasing every market move. Because while catalysts create excitement, long-term trends create wealth, and understanding which one you're looking at may be the biggest advantage an investor can have. One of the biggest mistakes investors make isn't buying too early. And it isn't buying too late. It's confusing today's headline with tomorrow's reality. Every market cycle creates moments exactly like the one we're living through now, moments where one economic report, one Federal Reserve statement, or one unexpected geopolitical event suddenly dominates every financial headline. Television panels debate it non-stop. Social media explodes with opinions. Prices swing widely within minutes. And it's easy to believe that everything has changed. But history tells a different story. Financial markets always operate on two different clocks. The first is incredibly fast. It reacts to headlines, expectations, breaking news, and emotion. The second moves much more slowly. It responds to demographics, debt, productivity, monetary policy, government spending, industrial demand, and long-term capital flows. Understanding which clock you're watching may be one of the most valuable investing skills you can develop. Because tomorrow's jobs report belongs to the first clock. The larger economic forces shaping gold, silver, interest rates, and your purchasing power belong to the second. Let's start with the short-term picture. Within seconds of tomorrow's jobs report being released, Wall Street's algorithms will begin making millions of decisions. Treasury yields may move sharply. The US dollar could strengthen or weaken. Gold and silver might gain or lose several percentage points before many investors have even finished reading the headline. If payroll growth surprises to the upside, investors will likely assume the economy remains stronger than expected. A stronger labor market usually means consumers continue spending, businesses continue hiring, wages continue rising, and inflation becomes harder to bring under control. If that's the case, markets may conclude that the Federal Reserve has less reason to lower interest rates anytime soon. Higher expected rates generally support Treasury yields. Higher Treasury yields often strengthen the dollar, and both of those factors usually create short-term pressure on gold and silver. Now imagine the opposite outcome. Suppose hiring slows dramatically. Perhaps unemployment rises more than expected. Suddenly investors begin asking an entirely different question. Has the economy started cooling faster than the Federal Reserve expected? If markets believe the answer is yes, expectations for future rate cuts may increase almost immediately. Treasury yields could decline. The dollar might weaken. Gold and silver could rally sharply. Notice something important. Nothing physical changed overnight. No new gold mines suddenly opened. No silver shortages instantly disappeared. No country's debt magically shrank. Only expectations changed. Markets spend every day trying to price tomorrow rather than today. That's why expectations often move prices far more than current conditions themselves. So before reacting emotionally to tomorrow's number, remember the question we've returned to throughout this entire discussion. What does this mean for your money? It means tomorrow's report matters. But it doesn't tell the whole story. Because underneath every short-term market reaction sits a much larger economic foundation. And that's where long-term investors should also keep their attention. Think back to 2008. Gold initially fell alongside stocks during the financial crisis. Not because investors suddenly stopped believing in gold, but because people needed cash. Liquidity became more important than anything else. Then central banks responded with aggressive monetary easing. Interest rates collapsed. Money entered the financial system at historic levels. Within a few years, gold reached entirely new highs. The same pattern appeared again in 2020. During the first stage of the pandemic panic, investors sold almost everything, gold included. For a brief period, cash became king. But once the Federal Reserve launched extraordinary stimulus programs and interest rates moved toward historic lows, gold recovered rapidly and eventually reached new record highs. Different crisis. Same economic mechanism. Short-term panic. Long-term policy response. Long-term recovery. History rarely repeats perfectly. But it often follows familiar patterns because human behavior changes far less than technology does. Today we face a different environment. Inflation remains an important concern. Interest rates remain significantly higher than they were just a few years ago. Government debt continues expanding. Central banks continue adding gold reserves. Industrial demand for silver continues growing through artificial intelligence infrastructure, renewable energy projects, electric vehicles, semiconductor manufacturing, and modern electrical systems. Those trends aren't determined by tomorrow morning's payroll number. They're structural, and structural forces often shape markets for years rather than days. This is exactly why experienced investors separate tactical events from strategic trends. A jobs report can change market expectations for several weeks. A Federal Reserve meeting can influence prices for several months. But debt levels, global reserve diversification, industrial demand, energy infrastructure, population trends, and monetary policy cycles, those forces can influence markets for an entire decade. That's why serious investors pay attention to both. The short term tells you how markets are feeling. The long term tells you where the economic landscape may eventually lead. Neither should be ignored, but neither should be confused with the other. So where does that leave us today? We know tomorrow's employment report could create meaningful volatility. We know markets will immediately reassess Federal Reserve expectations. We know gold, silver, Treasury yields, and the US dollar could all react quickly. That's the short-term reality. At the same time, we also know central banks around the world continue diversifying reserves. We know global debt remains historically elevated. We know industrial demand for precious metals continues expanding. We know monetary policy always moves in cycles rather than straight lines. Those are the longer-term realities. And together, they paint a much more complete picture than any single headline ever could. So instead of asking only, will gold go up tomorrow? Perhaps the better question is, what economic forces are quietly building beneath today's headlines? Because those are usually the forces that matter most. That's ultimately the purpose of this channel. Not to predict every market move, not to promise certainty where none exists, and certainly not to tell you exactly what to buy or sell. No one can responsibly do that. Instead, the goal is to help you understand the economic mechanisms driving markets so that when headlines arrive, you're prepared instead of surprised. Knowledge doesn't eliminate uncertainty, but it makes uncertainty easier to navigate. So tomorrow morning, when the jobs report is released and financial media races to explain every tick in gold, silver, stocks, and bonds, you'll already understand the chain behind the reaction. Jobs influence Federal Reserve expectations. Federal Reserve expectations influence interest rates. Interest rates influence Treasury yields and the US dollar. And together, those forces influence precious metals and, ultimately, your purchasing power. That understanding is far more valuable than simply knowing whether tomorrow's number is above or below expectations. Because headlines fade, economic mechanisms remain. If you found this breakdown helpful and want clear, fact-based explanations of what's really moving gold, silver, inflation, interest rates, and the US economy without sensationalism or false certainty, make sure you subscribe.